Let's talk about a topic that a lot of taxpayers have questions about: estimated taxes. So, how do you determine what to pay and when? So, in today's conversation, I'll be talking about those things and many more. So, stick around till the end.
One in a million, one in a million, one in a million. You know they're coming up to me, cause I'm just the kind of flow with a stinging on the beat, but the rhythm's getting higher. Go, 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 go. One in a million, one in a million, one in a million, one in.
Welcome back, folks, to another edition of the Awesome Sweetie Kiwi Show. How are you today? I hope you are doing fantastic. I'm doing marvelous, if you were to ask me. If you are doing as great as I am, go grab a cup of coffee or tea or vodka and let's roll. In today's conversation, we are going to speak about estimated taxes this year, how to determine what to pay and when. Let me first give you a definition. So we are on the same page. Everybody understands the foundation of today's conversation. So what are estimated tax payments? So if you are self-employed, you are generally required to pay taxes in 4 installments in a year. And those are called estimated payments instead of one lump sum. Okay. And the reason it's called estimated is because you are estimating how much income you will make this year and paying taxes on that amount. So federal income tax, self-employment tax, and any other applicable taxes. So the thing here is that, do you have to make estimated tax payments? Well, it really depends. If you intend to file as a sole proprietor this year, or as a partnership, as an S corporation shareholder, or as a self-employed individual, you will generally need to make estimated quarterly tax payments if you will owe taxes of more than $1,000. Okay, so it's very important to understand. Now, businesses that file as a corporation generally need to make estimated tax payments if they expect to owe $500 or more in tax for the current year. So if you meet this IRS minimums, then you likely have to file estimated tax every quarter. So now you don't need to pay estimated taxes if you are an employee. So basically, if you're an employee, your employer should be doing the quarterly tax withholding on your behalf. So that being said, sometimes they can get the amounts wrong. So you need to fill out Form W-4 and give it to your employer to make sure that they are deducting the correct amount. So, and if you are a special case, sometimes you can be a special case. In other words, if you meet all 3 very specific conditions that I will be talking about now, then you don't have to pay estimated quarterly taxes. Number 1, you did not owe any taxes in the previous tax year and did not have to file an income tax return. That's condition number 1. Condition number 2, you are a U.S. citizen or a resident for the entire year. And condition number 3, your tax year was 12 months long. If you don't meet all of the criteria for non-payment above, then you are one of the many Americans who need to file estimated quarterly taxes. Okay, very important. Now, estimating taxes requires a lot of planning. Okay, so let's talk about planning. So figuring out how to pay and when to pay. If you are an employee, your employer typically withholds taxes from every paycheck and sends the money to the IRS and probably to your state government as well. This way, you pay your income taxes as you go. And if you like most wage earners, you get a nice refund at tax time. But if you are self-employed, things become a little complicated. If you are self-employed, or if you have, let's say, income other than your employment wages, you may need to pay estimated taxes each quarter. You may owe estimated taxes if you receive income that is not subject to withholding, such as interest income, dividends, gains from sales of stock and other assets, earnings from a business, alimony that is taxable. Okay, now the question is, do you need to pay estimated taxes? Well, it really depends on the situation. The rule is that you must pay your taxes as you go throughout the year through withholding or making estimated tax payments. If at filing time you have not paid enough income taxes through withholding or quarterly estimated payments, you may have to pay a penalty for underpayment. Very important to understand. So to determine whether you need to make quarterly estimates answer these questions. We have 3 questions for you. Will you owe less than $1,000 in taxes for the tax year after subtracting your federal income tax withholding from the total amount of tax you expect to owe this year? If so, you are safe. You don't need to make estimated tax payments. Question number 1. Question number 2. Do you expect your federal income tax withholding to amount to at least 90% of the total tax that you will owe for this tax year? If so, you are in the clear too, and you don't need to make estimated tax payments. Third question. Do you expect that your income tax withholding will be at least 100% of the total tax on the previous year's return? Or if your adjusted gross income, Form 1040 Line 8B, on your tax return was over $150,000, $75,000 if you are married and filed separately, do you expect that your income tax withholding will be at least 110% of the total tax for the previous year? If so, you are now required to make estimated tax payments. Okay. Now, if you answered no to all of these questions, you must make estimated tax payments using Form 1040ES. 1040ES. And to avoid a penalty, your tax payments, your estimated taxes plus withholding during the year must satisfy one of the requirements we just talked about. So the big question is, which option should you choose? Okay, you're probably sitting there thinking, so what do I do right now? Well, that depends on your situation. The safest option based on our research to avoid an underpayment penalty is to aim for 100% of your previous year's taxes. So if your previous year's adjusted gross income was more than $150,000 or $75,000 for those who are married and filing separate returns last year, you will have to pay in 110% of your previous year's taxes to satisfy the safe harbor requirements. So if you satisfy this test, you will not have to pay an estimated tax penalty no matter how much you owe with your tax return. Very important. So the thing is, if you expect your income this year to be less than last year and you don't want to pay more taxes than you think you will owe a year end, you can choose to pay 90% of your current year tax bill. Okay, if the total of your estimated payments and withholding add up to less than 90% of what you owe, you may face an underpayment penalty. So you may want to avoid cutting your payments too close to the 90% mark to give yourself a safety net. And this safety net is really something that we actually tell a lot of our clients that, you really want to make sure you are around that amount. Okay. And if you expect your income this year to be more than your income last year, and you don't want to end up owing any taxes when you file your return, then make enough estimated tax payments to pay 100% of your current year income tax liability. So this is what it is. Now, having said that, I have a pro tip for you. Let me give you one pro tip. If you expect your income this year to be less than last year, and you don't want to pay more taxes than you think you will owe at year end, you can choose to pay 90% of your estimated current year tax bill instead of 100% or 110%, depending on your AGI of your prior year tax bill. So this is very important. So it's all about finding what category you find yourself into in terms of the option you should choose. Very important. I want to dig a little deeper here where I'm just trying to so how do you calculate estimated taxes? So to calculate your estimated taxes, you will add up your total tax liability for the current year, including self-employment tax, individual income tax, and any other taxes, and divide that number by 4, because we're speaking about estimated quarterly payments, right? 4 quarters. You can calculate your estimated tax on the IRS estimated tax worksheet found on Form 1040ES for individual filers, while corporations use Form 1120W for their calculation. So the worksheet will give you It will actually guide you through these calculations in detail and provide you with payment vouchers. Now, if you are using, let's say, software, the software will do the job for you automatically. Okay. Now, let me just give you an in-depth explanation about how to calculate your estimated taxes. Step 1, you want to estimate taxable income for the year. So let's start with Larry's income tax. In order to estimate how much income tax he'll have to pay this year, Larry estimates that his income for the year will be at a certain level. Let's say that he expects to make $90,000 this year. So he then subtracts any above the line deductions and think he'll incur anything for the year. Or, all the deductions that he thinks he will incur for the year. So 90,000 estimated income minus $15,000 above the line deductions, that's 75 grand. This new number is Larry's adjusted gross income. Then he subtracts the standard deduction for single taxpayers this year, which is $12,950. So Larry can also deduct 50% of his self-employment tax of $12,716. So he can deduct really $6,358. So his total estimated taxable income is $55,692. So next, you need to calculate your income tax. So next, Larry will multiply his adjusted gross income by his income tax rate according to the next year tax bracket to find his tax due. So tax brackets change each year, so be sure to consult the most recent numbers. So based on Larry's tax bracket, his estimated income tax owed for the year works out to be $7,869.24. Okay, and so this is very important to really understand. And what I want to say here is that, so first step, estimate taxable income for the year. Second step, calculate income taxes. Okay. Step number 3, you gotta calculate your self-employment tax. So because Larry earned more than $400 this year, he will have to pay self-employment tax. So to calculate self-employment tax, he first has to multiply his estimated total income, that's $90,000, by 92.35%. So this is effectively his self-employment taxable income. He then multiplies this number by 15.3, which is the self-employment tax rate. So where does the 15.3% come from? It's the combination of Social Security tax, which is a 12.4%, and Medicare, which comes to 2.9%. So 12.4% plus 2.9%, that's 15.3%. So together they make up the what we call the self-employment tax figure, 15.3%. So Larry's self-employment tax total equals $90,000 times 92.35% times 15.3%, which works out to be $12,716.59, which brings Larry's estimated quarterly taxes total to $8,130.24. That's the estimated income tax owed, plus the $12,716.59, which is the estimated self-employment taxes. So the total amount here owed is $20,846.83. Very important. So you need to add it all together and divide by 4. So that's the final step. So to calculate your estimated quarterly tax payments for each quarter, Larry simply adds together his income tax and his self-employment tax for the year and divides this number by 4. Voila, very simple. Okay, so $8,130.24 plus $12,716.59 equal $20,846.83. So this is Larry's total estimated tax for the year. Okay, so now you take that amount and you divide by 4. So $20,846.83 divided by 4, that comes out to $5,211.71. So that's Larry's quarterly tax payment. If you file your previous tax years with the help of a CPA or an EA, he or she should be able to send you estimates for this year's payments. And if you are paying estimated quarterly taxes for the first time, it cannot hurt to run your numbers by a CPA or an EA or a tax attorney before submitting. Let's dig a little further here. So the thing is, how should you figure what you owe? The thing is, you need to come up with a good estimate of the income and deductions you will report on your federal tax return. So you can use a lot of you can use software. It's a lot easier. You can use TurboTax. You can use Tax Act. You can use a lot of software out there to do the calculation for you. Or you can get a copy of the worksheet accompanying Form 11 from 1040 ES and work your way through it. Either way, you will need some items so you can plan what your estimated tax payments should be. So you will need, for instance, your previous year's return. Okay, so you want to use your previous year's federal tax return as a check to make sure you include all the income and deductions you expect to take on your current year's tax return. You should also look at the total tax you paid if you are going to base your estimated tax payments on 100 or 110% of your previous year's taxes. Very important to understand that distinction here. Okay, you also need to think about your record of any estimated tax payments and withholding you have already made for the year. So you need to take those payments into account when you determine how much tax you will owe. So you have to check, register, and the latest pay stub. You need to have your check register and latest pay stub handy to look up the numbers and the dates you paid. Now, if you have paid electronically, just go online here and have a clear idea of the payments you made to the IRS, either through the EFTPS portal or the e-file portal. Okay, so consider paying with your refund. This could be a great opportunity also. If you think that you will owe money when you file your next year's taxes, one easy way to get a jump on paying your bill is to apply your tax refund to your next year's taxes. If you won't have a federal income tax withheld from wages, or if you have other income and your withholding will not be enough to cover your tax bill, you probably need to make quarterly estimated tax payments. So having all or part of your overpayment applied to your estimated taxes is a relatively painless way to take care of at least some of what you owe for a common year. And a lot of our clients, a lot of people we know actually do that. It is a very, very smart approach. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of the Awesome Sorty Kiwi Show. We are still having a conversation about estimated taxes and how to determine what to pay and when. Let's talk about the due dates. Very important. So, when are estimated taxes due? As the name implies, estimated quarterly tax payments are due 4 times per year, right? So, April 15th, June 15th, September 15th, and January 15th. Or the next business day if it's a weekend or holiday. Okay, very important. So for this year, estimated quarterly tax deadline, you have to look at the calendar and see if it's April 15th. If not, it has to be the next business day. So for each quarter. So the first quarter, January 1st to March 31st, April 15th. Second quarter, May 31st. April 1st to May 31st, we have June 15th. For the third quarter, June 1st to August 31st, we have September 15th. And for the fourth quarter, you have September 1st to December 31st, January 17th of the following year. It can be January 15th, depends on the date it actually falls onto. Okay. One thing I want to say here is that what really works is that you can save these dates in your calendar at the start of every tax year. And there are nowadays, and there's a beauty of apps, mobile apps. You can actually have an app, a reminder app that will tell you whether or not important tax dates are approaching, and you can just set up the app to remind you maybe 1 month in advance or 3 weeks in advance, so you have enough time to plan and to actually organize yourself to meet your tax obligations. Okay. Now, note though, due dates, as I've said before, due dates that fall on a weekend or a legal holiday are shifted to the next business day. So this is it's very important to actually check on that. This is why I was just telling you to set a reminder that will alert you, let's say maybe 3 weeks in advance. I mean, definitely not 1 week in advance. No, you will not have time to do anything. You want to give yourself time, enough time to plan. If you would require help, if you need help, you have enough time to reach out to someone to kind of help you and actually get back to you and kind of help you pay or determine what kind of estimated taxes you need. Very important. Let's talk about payments, because payments are very important. How to make estimated tax payments. Now, submitting your payment to the IRS is a breeze. Really, it's really simple. Just fill out Form 1040-ES and mail it along with a check or money order to the IRS office closest to you. You can also pay by credit card online or by phone via the IRS Payments Gateway, okay, as you can see on the screen. And for corporations, payments must be filed through the electronic federal tax payment system. Now, there is some pain to be felt in terms of tax penalties. The IRS may impose penalties on quarterly tax payments for a few reasons. Not paying on time, not paying enough tax for the year. So to avoid an overpayment or underpayment penalty, you can either pay at least 90% of this year's tax bill, or pay the same amount that's 100% as the taxes you owed the prior year, whichever is smaller. Okay. Now there is something called safe harbor rule when it comes to estimated tax payments, and let me just talk to you quickly about that. So paying 100% of the taxes you owed on last year's federal tax return is sometimes referred to as the safe harbor rule. So even if your income grew this year, you would avoid penalties if you match the payments that you owed in the previous year, but you will still have to make up for the additional tax payments though. Very important. So one important caveat though, if your income is more than $150,000 per year, then you are required to pay 110% of what you paid in taxes last year. So paying taxes 4 times a year will not be the most fun thing to do as an entrepreneur, but proper preparation, organized record keeping, and tax-ready books can help make the whole process one of the most painless tasks. Okay, and when in doubt, we've said this before, it's very important. When in doubt, make sure that you reach out to an enrolled agent, a certified public accountant, a tax attorney, right? A tax professional can help you figure out your estimated tax payments to remove the guesswork. Okay, it's very important. Remember, here we are speaking about only federal estimated income taxes. Maybe in your state there could be some estimated state income taxes. Please check with your state tax department. Now let's talk about if you don't pay. And I have actually talked a little bit about that, but I really want to dig deeper here, because we have seen people have told us there are some videos on YouTube that talk about, well, you can still not pay and be fine. Hey, listen. You can end up owing the IRS an underpayment penalty in addition to the taxes that you owe. And the penalty will depend on how much you owe and how long you have owed it to the IRS. You might have to write a larger check to the IRS when you file your return. Now, is it what you really want? Think about that. So, should you pay in equal amounts? Usually, you pay your estimated tax payments in 4 equal installments, but you might end up with unequal payments in some circumstances. So, let's say if you had your previous year's overpayment credited to your current year's estimated tax payments, if you don't figure your personal estimated payments until after April 15th, when the first one is typically due, and if you unexpectedly make a lot of money in one quarter, this can happen too. You have a seasonal upticks in your monetary situation. Okay, so let me give you an example. You calculate that you need $10,000 in estimated taxes throughout the year, and you don't make your first payment until June 15th, when the second estimate is due. So your first payment will be $5,000. Your September payment and your January payments will be $2,500 each. However, you may still owe an underpayment penalty for the first quarter because the first payment was not made by the April 15 deadline. So you always have to pay. And let's just give a quick caveat for fishermen and farmers. So you have special criteria to meet, but you may end up paying less in estimated taxes. So you are considered a qualified farmer, or you're considered a qualified farmer or a fisherman if you earn more than 2/3 of your taxable gross income from farming or commercial fishing. So if you are not sure you qualify or how this all works, you can use software to determine whether or not you qualify. Okay, you can use TurboTax, you can use TaxAct, you can use there are a lot. You can use Credit Karma. You can use a lot of software out there to determine what really works for you. And you can figure out your taxable gross income and what fishing and farming income you can include as qualified income. Thank you so much for your attention in today's conversation. We were speaking about estimated taxes, okay, how to determine what and when to pay. So I gave you a definition. We talked about planning. We talked about calculation. We talked about due dates, and finally we talked about payments. Thank you so much for your attention. I really appreciate it. May the Lord bless you. I will see you next time. But until then, remember, stay marvelous.